Hi, traders. Welcome to this live webinar with FXDD. Thank you for joining. My name is Chris from Elite Currency, and this webinar is fully focused on moving averages. I'm going to share why I think moving averages are such a critical tool, why I myself am a big fan of moving averages, why it's my number one tool. In fact, my number one indicator that I use is moving averages. Together with fibs and fractals, they are the core of my trading. So I think moving averages have a lot of advantages. Here are 7 of those benefits coming up for Forex trading specifically. But I think, to be honest, moving averages is very, very useful for, I would think, all instruments, to be honest. But okay, I have most experience in Forex trading, so I wanted to focus on the niche that I have. Before diving into today's topic, though, please be aware of this risk disclaimer explaining the fact that trading foreign exchange and global financial markets is considered higher risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. And this webinar is for informational and educational purposes only. All right, so let's continue and let's start with the moving averages. I'm very excited about that because I think there's so much value and information to be found with moving averages. But before we dive into those, what levels are typically used? Very quickly, I don't want to dive into the beginning aspects too much. I want to dive into more advanced techniques of using moving averages. But for those that are maybe new to MAs, here are 2 typical ways of approaching that. The most typical are round levels, to be honest. 10, EMA, 20, 40, 50, 100, 200. I myself, as you might know, am a huge fan of using Fibonacci levels throughout my trading, and that in terms of Fib targets, Fib ratios, Fib retracement, Fib sequence levels, and Fib levels as well for moving averages. So that means 13, 21, 34, 55, 89, 144 EMAs. Specifically, my favorites, 21, 34, and 144. Netted likes 89, for instance. So yes, we are big fans of Fib levels in also moving averages. All right, now let me zoom in to the presentation. There are different types of MAs. I don't want to dive in that too much, but basically EMAs and SMAs are the most used. We personally use EMAs. So let's dive into more advanced stuff. And the number one benefit of moving averages, or actually, this is not in sequence. This is not like this is the most important, by the way. I should say it's just the first one on the list, but it's not necessarily the most important. Okay, is the moving average is a target when a divergence pattern appears. So that's something I call a hidden benefit because not many traders know about that. They don't understand, especially in Forex markets, certainly so, is that when price retraces or reverses, the moving averages are in a way a bounce spot, but also in a way a gravity spot, right? Because price kind of gravitates back to the mean, back to the average. So when their divergence pattern is visible, the first level the price typically goes to is the 21 EMA, as I call it, the zone, which is the high and the low. So that's typically the first moment where price moves into. And the second one, if price then breaks through that 21 EMA zone, the second is then the 144 EMA close, which is the long-term moving average. And once price reaches that moving average, then officially the divergence target has been hit. And that divergence pattern on that time frame is not a factor anymore. So that's important too, because once prices hit the 144 EMA, that divergence is not a factor in my trading, at least anymore. Of course, there could be divergence pattern on a higher time frame, and that could still be valid and that could still be relevant, but not on that time frame at least. So let's say on a 4-hour chart. Oh, I cannot show you with my drawing tool, actually. Let me use this. I'm not sure if you see that. Hang on. Let me use this drawing tool. That you should be able to see. So, oh, sorry about that. Okay. So, but I cannot. Doesn't matter. I will not draw it. It's too complicated, I think. And I'm losing representation now. So let's skip that idea. And let me just show you the charts later on with some examples. All right. Hang on. All right. So anyhow, basically, keep that in mind. This is one of the hidden benefits of moving averages. And yeah, if there, oh yeah, I was saying, now I remember. If price, there could be different divergence on a higher time frame. On a daily chart, that could still be, a factor. Of course, higher time frame divergence is stronger, and therefore price is more likely to go to the 144 EMA. On lower time frames, divergence is weaker, and therefore the 21 EMA is more often a target. Things change on lower time frames if there's multiple divergence present on lower time frames, then the 143 EMA is more often a target. So you need to have more divergence on lower time frames, and on higher time frames, a single one is enough. 4-hour chart and higher. Of course, if there's divergence on multiple time frames, then even more likely that price is retracing back to the 144. And of course, it doesn't have to necessarily stop at 144 EMA. It could go beyond that and show a reversal. But the first target for retracement is the 144. If price goes beyond that, if it breaks, if there was an uptrend and it breaks below 144 EMA, it could be a total reversal, of course, as well. Specifically, if there's multiple divergences on multiple time frames, then a reversal is becoming more likely, and price could even go beyond the 144 EMA. All right, so second benefit is the fact that it shows momentum. It's a very good measurement of momentum, impulsive price action, quick price action, basically, one directional price action. So, for instance, the 21 EMA zone, high and low, the angle of that. So if it's steep, if you look at a clock and the angle is from, let's say, from 7 to 1 p.m., right? From like that, then that could indicate a very steep angle to the upside. If it's from 11 to 5, that could indicate a very steep angle to the downside. If it's more like 9:30 to 3:30 angle like this, well, that's flat. So a very steep angle of the 20 EMA indicates momentum. That's one thing. And of course, the steeper, the more momentum. The shallower, the flatter, the more corrective. That 21 EMA zone helps identify that. You can also use 34 EMA. That is something that a famous trader called Reggie Horner uses, and is called, I think, the wave for moving averages. Very beneficial too. I personally like the 21. It's a little bit more tied into price, a little bit quicker responsive, and the angle even maybe more important, I think. But small difference. Other key moving averages for momentum is a short-term moving average, 5, 8 EMA. Very useful for understanding that, but also comparing two EMAs, 5 versus 21, 5 versus 8, 5 versus 13. Very good for understanding momentum here right now. So that can give extra benefits or extra information. And also the space between the 21 EMA and the 144 EMA. So if the space is increasing, 21 EMA zone is being pulled away from the 144, up or down, then that is also often a case of momentum. So these are three things: space between 21 and 144, the 21 angle, and short-term moving averages versus each other. 5 versus 13, 5 versus 8, 5 versus 21. All of these combinations are valuable. Depends what you like. Really, there's or not even only 5. It could be 8 versus 21. Any of these combinations really, I think are have their benefits really. So these are three kind of concepts: short-term moving averages, using the zone, and the 21 versus long-term. Yeah, thank you, Hussein. Very happy to hear that. I'm also a big fan of the 21 EMA zone and the 144, and the combination is even more useful. So happy that you see that. And yeah, besides divergence and momentum, there are many more benefits. I'm going to share 4 more at the very minimum. But I think above all, maybe what I don't have mentioned here is that I understand the charts with more depth, but not necessarily that it takes me so much time to understand. So I get a very deep analysis quickly. That's what I'm trying to say. And I don't think that it can be done in such a way. I'm sure there are other ways to do that. I mean, Nanette, for instance, loves using bands, for instance, and I do think that that's also a very quick way of understanding the chart. So, but it's definitely one of the ways, moving averages, to do that. So the third benefit, trend. This is a more classical kind of information, and most of you probably know that, but still worth mentioning for those that are maybe new to trading, is the fact that, yes, the trend can be determined. I personally use 21 versus 144. So if I see 21 simply above 144, uptrend. 21 below 144, downtrend. If the 144 is in the 21 EMA zone, then question mark. Trend could be both ways. If price versus 21 EMA, that's also important for short-term trend. So 21 versus 144 is more about long-term trend. Price versus 21 is more about short-term trend, both giving a lot of info about full trend, right? Price 21, 144 is full uptrend, or 144, 21 price is full downtrend. If 21 and 144 are aligned, but price is either at 144 or at 21, it's a trend, but retracement. There's a pullback going on. Then, of course, obviously support or resistance. So 21 EMA, 144 EMA acting as that potential support or resistance. Specifically, if there is a strong angle, then they have more value as support or resistance. If price is in a range, then they don't provide much value as support or resistance. In that case, they tend to be a gravity. They tend to be in the middle of the range. So this is specifically valid when there's a trend or momentum going on. And if there is a trend or momentum going on, then they typically, those levels act as bouncing spots. And a confirmation of bouncing spots could be fractals at the 21 EMA, fractals at the 144 EMA. Two, by the way, I don't have it mentioned here, but same thing. And time patterns. All of that could indicate a bounce or perhaps a reversal at these moving averages. These moving averages are used as a spot where the trend might continue, for instance. But they are not only could they, the 21 EMA and the 144 EMA provide bouncing spots, but also breakout spots. The 21 EMA could first act as a bounce zone, and then as price re-breaks below for a downtrend or re-breaks above for an uptrend, it could be a trend continuation breakout. And in fact, it could also break the 144 EMA, and that could actually indicate a reversal breakout as well. Again, not mentioned here, but that's valid too. And the breakouts, well, they could also be basically measured with different levels, 5, 8, 13, or the HMA, for instance, as well, could be used for a breakout, price breaking above it, below it, for a momentum continuation. All right, so if price breaks below the 20 EMA zone, that could be bearish breakout. If it breaks above the 20 EMA zone, that could be a bullish breakout. And benefit number 7, so reversals. If the price is showing like pound Australian dollar today, making an ABC correction, maybe in any case looks like a reversal. It broke below the 20 EMA for a reversal. And if it breaks through the 144 EMA, then that is even a stronger sign of reversal, right? Reversals go in stages. You first have a candlestick pattern, then you see price move to the 21 EMA, then you see it break the 21 EMA, go to the 144, then you see price going through the 144 and the fractal at the 144, then you see the 21 EMA cross the 144, and then it's finally a different trend direction. All right. I'm going to show you live charts to walk through these examples. But if you're interested in finding out, if you're looking at the live webinar now and you want to join more live webinars, if you're looking at the recording, and you want to join live webinars, then these two links are how you can find us. top one live trading webinars, bottom one for live educational webinars like this. If you're watching now live, then you can check out FXDD YouTube channel and check out more videos from Ned and myself regarding trading ideas, analysis, and of course, recordings of these webinars. So with that said, now let me close that and let me open up the charts. Hang on, folks. I need to find, I hope I have it now. All right. Yes, good. I hope you'll be seeing my screen now. So I was a little bit confused because it seemed to be freezing, but I think it's working now. Good. So with that said, let's move on. I wanted to give you more practical examples. Alrighty. And let's take a look at benefit number one, which was divergence pattern, and give some examples of that. So for instance, let's take a look at this pound dollar, and let's take a look if we can find some example. Okay, so here there is a lower low on price, but the oscillator not providing a lower low. So that's classical divergence. So price going back to the 20 MA, right? Right here, as you can see. Here, that's the first step. And then the second step is when, if there is a potential, if there is that second step, not always, this happens, but in this case, yes, break above the 20 MA and then move up to the 144. It actually went a little bit further than that, didn't it? It went up beyond that 144 MA, and that can happen. I mean, 144 MA is just a rough target, but it did indeed get to the 144 MA. Sometimes it misses it. It's also possible, but that's generally the rule of the idea behind it, basically. So first to the 21, then to the 144. Maybe one more example. Let's see here. And I think that's a double divergence, basically. And specifically on the hourly chart and lower, that sometimes is needed because the first divergence only brings price back to the 21. Then we get a double divergence with the next high. Then price not only goes to the 21, it actually right away breaks to the 144. An immediate push through to the 144, in fact, almost ignoring the 21 you made. That can happen too if there's a stronger reversal. And that indeed happened because this was a push down, some consolidation around the 144 you made, and then in fact the trend changed back down again. So that's divergence example on the chart. Let's see. Benefit number two, I said momentum. So I talked about three things, if you remember. First of all was the angle of the 21 EMA. So of course you want to be careful about how you squeeze price. Obviously, if you squeeze price like that, you'll see a steeper angle. But if you keep things, you want to basically have a view that you are familiar with. But if you, let's say, use this view, then obviously this is a pretty steep angle of 21 EMA. So that's indicating that the 21 EMA likely to act as resistance. So resistance, resistance, resistance. But not only that, after that, when the 21 EMA still goes flat, it's still used as resistance because the 21 EMA was so strong here. So the flatness indicates just a continuation after that. So the 21 EMA angle here, but not only that, the space between the 21 and 144 is increasing. That's indicating momentum. And if we were to add a 5 EMA, for instance, let's do that. Hang on. I need to add that though quickly. All right. But let's make it a different color. Let's say purple and make it a little bit more visible. All right. So 5 versus 21, for instance. So if it recrosses below it, could be 1. Or if you have a shorter term moving average, for instance, let me use 13. It could even be a crossover, in fact. We don't get one here. Or not only the crossover, but the difference here indicating momentum. So it could be a crossover as an extra confirmation. I wouldn't necessarily use that as the entry only, but it could be a confirmation of an entry, and the space gap here as well. That's 5 versus 21 or 5 versus 13, etc. So those are the 3 things: 21 EMA, the space between the 144 and 21, and then the 5, for instance, moving average. Then the trend. All right, so let's take a look at that. Once again, I said 21 versus 144. So this is downtrend already. This is a pullback. This is indecision. So the trend could be both ways. And here's downtrend again. 21 clearly below the 144, and it stays a downtrend, and it stays a downtrend. All right, 4-hour chart, downtrend since, well, for a very long time, since May. And it's been in a downtrend. Only here, there was a question. It could be both, because the 144 is in the 21. But after that, only downtrend. Okay. And with regard to momentum, the 4-hour chart is a classical example of that. Look at this momentum. Look at this angle. Look at the space. Okay. And if we add a short-term moving average, I'm sure we'll see a lot of info too about that as well. Oh, and one more thing, actually, I didn't mention. The number of candles below the 21 EMA not hitting the 21 EMA zone. That too, again, another important factor for momentum, by the way. With regard to trend, though, this was all downtrend, 21 below the 144, and here price below 21, so extra downtrend. At times when price was above 21 EMA, downtrend, but retracement, downtrend. Let's see. And here there was a pull. This was a retracement. These are minor pullbacks, and this was a full retracement because price went back to 144. So that's trend. Then benefit number 4. So support of resistance, 144 and 21 EMA. So as you can see, resistance. Here, resistance. We got a break, but ultimately the trend didn't change. And it was, again, once it broke through support, back in a downtrend again. So key levels of resistance, support with the 144 EMA. And if, in the 21 EMA, again, if it's strong trend, it will be used as a potential bouncing spot and break spot. So here, for instance, let's see. I can't find very good examples here, but anyhow, pound dollar was a little bit too impulsive. But let me go back a little bit, maybe find some examples here. For instance, here. In recent time, the price was basically just below the 20 EMA and pulling away from the 20 EMA, so it really didn't use the 21 EMA, but it is also resistance and a bounce spot, and also breakout indication here, right? As it continues lower like that, following through. That, by the way, here too, for instance, a continuation breakout once price rebreaks below the 20 EMA. Here too. Rebreak below the 20 EMA. All right, so I went a little bit ahead of myself because now I spoke a little bit about bounces already. But so, for instance, a fractal at the 21 EMA here, very critical information that price is bouncing indeed, most likely. So when the fractal closes somewhere in here, that's already key information that this retracement might be over, that price has broken support, broken support line, made a lower low, and it's finding resistance at the 21 EMA. Fractal at 21 EMA, very important. Fractal at 144 EMA too. These bounce spots, these fractals indicating bounces, these fractals indicating potential break. All right, so fractals indicating bounces at 21 and 144, but as I mentioned already, breakouts too. So the push through this fractal and this fractal indicating the breakout with the trend here too, for that matter. And let's see. Here, potential reversals, breakout reversals. That didn't go that far. This went a lot further. Let me find an example here. This one too, this breakout below the 144 MA, indicating a very strong downtrend at that point. This break of this fractal didn't go very far, but still almost 150 pips, I guess. So these reversal breakouts can go far. Not always. You get sometimes periods like this. Back in March, there was a huge range. And then these breakouts of the fractals didn't go necessarily too far. And in this case, the fractals were very far from the 144. So not so valuable here. There was a breakout. Here, didn't go anywhere. Here, the fractals were quite far. So in this case, that's because it's in a range. And in that case, as I said, if it's in a range, the 144 EMA is going to be smack in the middle. So in that case, then that changes perspectives. And you want to be on guard for breakouts at that spot. And keep an eye on the tops and bottoms, basically. Okay, but if it's trending or reversing, then 144, 21 EMA, very good for bounce and breaks. And also fractals at the same 21 and 144 EMA. Okay, let me check if there are any questions. Yes, candle size is absolutely also very important for momentum, indeed. And couldn't agree more. Didn't mention that though, because it's the focus on moving averages. But yes, definitely. We can also understand momentum just by looking at the series of candles, by, for instance, looking at the series of lower lows and higher highs. For instance, here, right? This is momentum. Just looking at price, we can see that as well. And here, 3 out of 6 candles showing higher highs. That's the start of momentum. And we know that this is a momentum swing because the majority of candles are bullish. Majority of candles have a close and a high. Majority of candles of the bullish candles are strong, big in size. The bearish candles are small, corrective, and in the minority. Majority is bullish. So that's all characteristics of momentum through price action. Absolutely. Here's the start. And when 5 to 7 candles failed for a higher high, that happened 2, 4, somewhere in here. That indicates probably that this was the end. So this was the start. This was the end. And that's one swing. And that's how we can know that in retrospect, but also at the time it's happening, in fact, using these concepts. And that's basically using candles and time patterns. And that's very useful information. And the moving averages are in that case useful when price, for instance, either here at the breakout for a swing setup on the 4-hour chart. If price is above 21 EMA, then lower time frames would be needed for either bounces at the 21 EMA on lower time frames or breakouts as well on 1-hour chart, on 50-minute charts. Let's take a look at this zone from the breakout on the 4-hour chart to the reversal spot. That's 2, 4, 6th candle here. Let's take a look at this zone on the 1-hour chart. So we had one breakout here on the 4-hour chart, one swing setup, but on a lower time frame, we might see more. So we see here a flag. So this could be a breakout. We see here a pullback on the 21 EMA. Here we see a breakout and another breakout or pullback or bounce basically at the 21 EMA. And here we know already from the higher time frame that this push up is running out of steam. So that's on the 1 hour chart. On the 15-minute chart, there could be also pullbacks and breakouts on a lower time frame that are potentially visible as well. So yeah, that's basically how you can, if you see momentum on a higher time frame, it's possible to dive into lower time frames and catch a part of that. Just be careful that eventually, of course, momentum runs out of steam, trend runs out of steam, and then a bigger correction will take place. So specifically at the end, when divergence patterns take place and stuff, and there are more reversal chart patterns visible, time patterns, etc., then got to be careful because, of course, trend momentum could be running out of steam and ending basically. All right, I think that is about it. All right, thanks for joining. Good trading, everyone. Nennet and I are going to be back with more webinars later this month, so check those links out. And I wish you all, once again, good trading. See you very, very soon. Cheers. Bye-bye.